strategies, and we were doing straddle as a combination strategy, wherein along with going long on a stock, you also enter into call and put options. Under a long straddle, you are long on the stock and you buy a call and put option to safeguard yourself against fluctuation in prices the either way. That is, even if the prices increase or they fall in the market, you have a call and put option to protect yourself against those price fluctuations. Now, just the opposite of long straddle is a short straddle. You are long on the stock, you are holding some shares, but you are also selling. You are going short on a call and put option. Okay. Now you are taking the risk of selling both a call and put option. This kind of risk is very calculated. The investor feels that there won't be much fluctuation in the market and that both call and put option won't be exercised by the buyer. Okay, so investor is selling these options in the anticipation of least fluctuation in the price or no fluctuation in the price, wherein the buyer of these options won't be exercising them and hence he'll get to pocket both the premiums, that the premium on call option and on the put option. Now, this is a strategy for advanced investors because otherwise the loss can be unlimited. If there's any fluctuation the either way, being the writer in both the options, you are at a loss. So generally preferred by advanced investors in the market. So we move ahead. We'll take an example. I'm taking the same value, same example as we took for long straddle. There is a call option which you are selling at 7600 with a premium of 77 rupees. While there is a put option again with an exercise price of 7600 with a premium amount of 88 rupees. So again, by selling both the options, the writer, that is the investor in this case, is earning a premium sum total of 77 plus 88 equal to 165. So let's start with the first scenario. The market expires at 7200. Now you have sold both a call option and a put option at 7600. The call option will lapse. The buyer won't ask you to exercise the call option, but the buyer will ask you to exercise the put option. That is, now he will want that you should purchase the shares from him at 7200, sorry, at 7600 when others in the market are selling the same shares at 7200. So as you can see here, the call option will expire worthless. What you get is a premium of 77 rupees. On the other hand, in case of put option, you are losing 400 rupees. Okay, the worth of the share that you are buying currently is 7200, but you are paying 7600. So 400 is that loss. The put option is out of money by 400, but you have earned a premium of 88. So your net loss from the put option is 312 rupees. If you adjust this, you are making a net loss of 235 when the market expires at 7200. Okay, so this is a negative zone, red zone under the short straddle. Next, when the market expires at 7435. Okay, now 7435 was the value. That is your exercise price minus the premium amount. Okay, so this was break even in case of long straddle also, and that becomes a break even in case of short straddle. Here at 7435, again the call option won't be exercised. You make a profit of 77, but the put option will be exercised. You are making a loss of 165 because you are buying the share from the holder at 7435, sorry, at 7600, while market price is 7435. So there is a loss of rupees 165. Okay, but you have earned premium also on the same option. So your net loss becomes 77. Now, when you add up both the values, you will see that you are coming to a 0 point. You are coming to a break-even point where your profit and losses are the same, and hence this becomes the lower break-even point under the short straddle. The upper break-even will be 7600 plus 165 of the premium. So the third scenario is, I'll take up this point so that lower and upper break even we are taking together. So when the market expires at 7765, 7600 plus 165, in this case your put option will lapse while the call option will be exercised. Now you need to sell the share to the holder of call option at 7600 when the market is at 7765. So there is a loss of 165. If you adjust both the premiums, your net profit net loss becomes 0. This becomes the break even point. In the short straddle, this is the upper break even point because you are at a higher price. The best scenario for the investor is when the market expires at 7600. Okay, both the options will lapse and the profit made by the investor will be rupees 165. So this is also the maximum profit the investor can make. The market is expiring at the money. The strike price or exercise price is equal to the spot rate in the market. And then if market expires at a higher level at 8000, again call option will be exercised, put option won't be exercised, and the net loss from this strategy comes to 235. So these were the 5 scenarios under short straddle. If you have a look, this is what the payoff for a short straddle looks like. It is just the inverse of long straddle. Okay, maximum what you earn is at 7600, as you can see in the figure, and then 7765 and 7435 are your break evens. Below this, below 7435 or above 7765, you are making losses. Okay, so I hope straddle is clear to everyone, long straddle and short straddle. So we come to the next combination strategy, which is a collar. Okay, now collar is also going long on the shares, but along with that, you are entering into protective put and covered call जो दो स्ट्रैटेजीज हमने इनिशियली करी थी, बट both are out of the money. Okay, so let me explain this to you. Your position in collar is you are long on the stock. You have purchased the share, then you have purchased the put option. So that was the protective put, जहाँ पर to safeguard yourself against the possible fall in the share price. You purchase a put option, and then you are also making a covered call. Covered call क्या होती है? When you are selling a call option. So in this case, you are the buyer, while in this case, you are the seller. Okay, what is unique here is that both these option contracts are out of the money. So when is a put option out of money? What is out of money means? Yes, anyone? What's the meaning of a out of money put option or a out of money call option? None of you remembers? Does anyone remember what intrinsic value of option means? Yes, class, at least attempt. Okay, price is below strike price. So you are talking about put option. Yes, absolutely right. Good. In this case, intrinsic value is basically the difference between the spot rate and the exercise price, or this way you write it in either of the ways depending on whether it is a call option or a put option. Now, when the spot rate in the market is greater than the exercise price, which was the first case, your call option is said to be in the money. ओके, तो इसका ये मतलब है कि कॉल ऑप्शन आउट ऑफ मनी कब होगी? व्हेन योर एक्सरसाइज प्राइस इज हायर than the strike price. Sorry, the exercise price is higher than the spot rate in the market. So this call option will be out of money. Vice versa will be case for put option. If the spot rate in the market is higher than the strike price, then the put option is out of the money. Okay. To explain it further, let's take an example. Prices देख के आपको पता चलेगा कि option out of money है. So just come to this slide. Let's first read the example and then we'll move further with the explanation. So there is a share which is currently trading at 48. You have purchased the share at rupees 48 and you have also written a covered call. 50 rupees की call आपने write करी है, while you have purchased 45 put. तो करंट जो स्पॉट रेट है एस टी, that is 48. Your say this is x1 the strike price of put option. Even better, I'll write it XP, and here XC, this is the exercise price for the call option. जब शेयर 48 का है और आप कॉल सेल कर रहे हो 50 रुपीज की, तो at this point the call option is out of the money because your exercise price is greater than the spot rate. This call option is out of the money क्योंकि मार्केट से ही शेयर 48 का मिल रहा है and under covered call you will be selling this share at rupees 50. So currently this call option is out of the money. Similarly for put option, मार्केट में आप शेयर सेल कर सकते हो 48 रुपीज का, while under the put option you can sell the share at 45. So you can sell the share at a higher price directly in the market. So currently this put option is out of money. Your spot rate in the market is greater than the exercise price. Okay, so first thing, I hope you are clear with what out of money option is respectively in either of the cases. Okay, now let us see what happens, what is the maximum profit or loss that the investor makes on such option strategies. So what you are doing is you have purchased, the investor has purchased 100 shares at rupees 48 per share. Okay, so 4800 is the investment in the shares. Now he has written covered call at rupees 2 per share, which means investment, I'll write down, investment in shares is 4800. कवर्ड कॉल में आप सेल कर रहे हो कवर्ड कॉल, सो यू आर अर्निंग अ प्रीमियम ऑफ 200 while protective put is being bought by the investor for which premium is 100 rupees. So currently the investment stands at rupees 4900. Okay. So basically, I think we should write it as minus 200 and plus 100. तो अब सही वैल्यू आएगी. आपकी पॉकेट से 4900 गया है while you have received 200. So your total investment is 4700. This would be the correct way to write. Okay. So what happens when the price fluctuates on either side? Let's start with upper price fluctuation, that is the price of the share increases to 53 rupees. Okay, so what happens in this case is that your call option will be exercised while the put option will lapse. I repeat myself, the call option will be exercised while the put option will lapse. इसका क्या मतलब है कि आपको शेयर सेल करना पड़ेगा at rupees 50. So which means 4800 के जो shares थे, you will be selling at rupees 50. So one profit that you are making on sale of the shares is 200. Okay, then you have also received a premium of 200 on the call option as the writer of the option. So this is the premium amount, but there is also a premium that you have paid for the put option, that was 100. So now Your net profit from this strategy comes to rupees 300. 4800 के शेयर्स आपने परचेज करे थे. You are selling those shares at 50 rupees. 5000 rupees, 200 का प्रॉफिट वहां से आया. कवर्ड कॉल आपने राइट करी थी तो 200 का प्रीमियम आपने वहां पर अर्न करा. पर प्रोटेक्टिव पुट आपने परचेज करी थी तो 100 का प्रीमियम आपने पे करा. योर नेट प्रॉफिट इज कमिंग टू 300 rupees. This is the first scenario, that is where the price of the share has rallied upward. Okay, so this is the maximum profit you can make on the caller option is equal, the maximum profit on caller is equal to call option strike price less underlying stock purchase price. So this is the maximum profit and you are also adjusting the cost of the option here. Now second case is when the price falls. So you can have a look here when the price falls to rupees 43. अब इस केस में आपकी कॉल ऑप्शन एक्सरसाइज नहीं होगी. Put option will be exercised by you. So now when others in the market are selling at 43, you will be able to sell the shares at 45 rupees. 45 was the value of the exercise price of the put option. Now the problem is that these shares were bought at 48. So what is the net payoff? 4800 के शेयर्स 4500 में सेल हो रहे हैं. तो पहली जो लॉस की अमाउंट है दैट इज 300. ओके, you have also paid a premium of 100 rupees on the put option. Purchasing the put option, ये put option का प्रीमियम है, put premium. This is the loss on sale, but you have earned a premium on call option. So plus 200. So your net loss becomes 200. So under this strategy, your profits are also capped and your losses are also capped. First, have a look at these values. Is the example clear? Any question, any doubt in this? Yes, class. अमित क्या समझ नहीं आया? ये वाला पार्ट समझाऊं कि पिछला वाला भी समझाऊं? Yes, others also, if there's a doubt, please ask. At once, things won't be clear. If you want, I'll repeat. So this means it is clear to everyone. Amit, you have a question or there's no doubt? Okay. Okay, so under this strategy, you are limiting your losses, but you are also limiting your profits. So here the maximum loss is the purchase price of the asset less the put option strike price, and then cost of the option is factored in, means you are adjusting the premium also. This is how the payoff for a caller option strategy looks like. Limited losses as well as limited profits. Okay, so we move ahead. The next strategy is a spread strategy. Now, option spread is buying and selling equal number of options. Okay, so you buy call, you sell put, you buy put, you sell call, you buy two calls, sell two puts, and so on. So the number of option contracts you are trading in is the same, but they can have, but they will have different strike price or expiry date. ओके, अभी तक हम कोशिश कर रहे थे कि जो भी हम ऑप्शन स्ट्रैटेजीज में एंटर करें उनमें एक्सपायरी डेट सेम हो और स्ट्राइक प्राइस भी सेम हो, दो प्रीमियम वाज डिफरेंट. Now we are entering into simultaneous option contracts with different expiry dates or different strike price. Now, how does it work? We will take up examples for the same, but for the time being, understand that there can be vertical spreads or horizontal spreads. Vertical spreads are having different strike price, same expiry date, same underlying asset, same number of option contracts. While horizontal spreads will have different expiry dates but same strike price, same underlying asset, and same number of options. So let's take example for vertical and horizontal spread. So vertical spread, you have two option contracts. You are buying and selling a call option, or say you are buying and selling a put option but with different strike rates. If you bought a rupees 60 June call option and sold a rupees 70 June call option, you have created a vertical spread. तो नेचर ऑफ कॉन्ट्रैक्ट सेम है. इस एग्जाम्पल में आप कॉल ऑप्शंस में ही डील कर रहे हो, अंडरलाइंग एसेट भी सेम है, से शेयर वाली ऑप्शंस है, स्टॉक ऑप्शंस है, बट द स्ट्राइक प्राइस फॉर बोथ द ऑप्शंस इज डिफरेंट while the expiry date is the same. कैलेंडर स्प्रेड में क्या होगा? आपकी एक जून की ऑप्शन होगी और एक जुलाई की होगी कॉल ऑप्शन, दोनों का स्ट्राइक प्राइस सेम होगा and the underlying asset will also be same. Okay, so what we'll do is we'll stop here. We'll go into detailed spread strategies tomorrow.